Welcome to this explainer. Today, we're diving deep into the engine of one of India's most fascinating retail giants, Metro Brands. We're going to break down both their fundamental business and the technical landscape, specifically looking through the lens of their incredibly strong Q4 FY26 results. Whether you've been tracking their massive footprint, their high-profile brand partnerships, or just watching the stock charts, well, there's a really compelling story unfolding here.
Here's our roadmap for today. First, we'll map out the Metro Brands empire. Second, we'll unpack that Q4 financial breakdown. Third, we're going to dive into their competitive moat. Then, look at their key strategies for growth. And finally, we'll hit the technical analysis and charts. Let's get right into it.
Section 1. The Metro Brands Empire. To really grasp the financial numbers later, we first need to visualize their massive retail scale.
To truly understand the gravity of this company, you've got to anchor your mind on this one single massive number, 1,032. That's the number of physical stores Metro Brands was operating at the end of fiscal year 2026. I mean, building a network of over 1,000 stores, that is a monumental operational achievement. And honestly, it forms the bedrock of everything else we're going to talk about today.
And this map brilliantly illustrates exactly what that kind of dominance looks like on the ground. We're looking at a pan-India footprint spanning 31 states and union territories. They aren't just clustered in a handful of major hubs, They've built a deeply diversified presence that captures aspirational consumer segments across 221 cities nationwide. They are practically everywhere the Indian consumer is shopping right now.
Now, what's genuinely brilliant about this setup is how they manage that massive footprint. They don't just plaster one name on 1,000 storefronts. Instead, they act as a highly strategic one-stop shop, segmenting those stores into heavily targeted brands. You've got Metro, targeting the whole family with 374 stores. Then there's Mochi, capturing the youth market with 288. And then check out their exclusive outlets catering to the premium segment, specifically 232 Crocs stores and a growing number of FitFlop locations. It's like a giant puzzle, covering practically every age demographic and a massive spectrum of price points.
All right, moving on to Section 2, the Q4 FY26 financial breakdown. Let's dig into the headline numbers and see how this carefully constructed empire actually performed.
So, the absolutely crucial context here is the macroeconomic tailwind they caught during this quarter. Remember, retail doesn't happen in a vacuum. Metro Brands capitalized on a perfect storm, massive festive and wedding season demand across India, which was strategically supported by a highly favorable reduction in GST rates for footwear priced below 2,500 rupees. Talk about a catalyst for consumer spending, right?
And wow, did they capitalize on it? Looking at these numbers, those tailwinds translated into phenomenal growth. We're seeing roughly 20% year-over-year increases virtually across the board. Standalone revenue jumped nearly 20% to 757 crores. Consolidated EBITDA up 20.5% to 238 crores. Listen, when a company with over 1,000 physical locations is growing both its top and bottom lines at 20%, that tells you their operational leverage is just exceptionally fine-tuned. And if you look at this multi-quarter trajectory, it visually confirms this wasn't just some one-off lucky quarter. Not at all. It demonstrates robust, sustained revenue generation leading right up to and through that vital Q4 period. Going from 651 crores in Q2, peaking at 811 in Q3, and landing a very strong 773 crores in Q4. All the while, they managed to maintain highly impressive profit after tax margins right around 15.2%. So it's not just growth, it's highly profitable growth.
Section 3. Unpacking the competitive moat. Because numbers only tell us what happened, we need to understand the underlying architecture protecting those profit margins in what is normally a notoriously tough retail sector.
Pulling from the source data, we can distill their market advantage into these 8 core strengths you see here. But I want you to focus on 2 absolute standouts. First off, their asset-light business model. They aren't tying up massive amounts of capital manufacturing everything themselves. Instead, they rely on deep, machine learning-driven vendor engagements. Pretty smart. Second, they've positioned themselves as the go-to platform, the absolute platform of choice for third-party international brands, like Crocs, who want to seamlessly enter the complex Indian market.
But the real magic of this moat, the thing making them future-proof, is their omni-channel execution. They aren't just sitting back on their vast brick-and-mortar legacy of 1,000-plus stores. No way. They are actively driving a massive 39% year-over-year surge in digital e-commerce revenues. E-commerce is now kicking in almost 13% of their overall revenue. This right here is exactly how you bridge the gap between traditional retail dominance and the modern digital consumer.
Which brings us to Section 4, key strategies for growth. Knowing their current strengths is great and all, but the market is always looking forward. How exactly is management planning to scale this beast even further?
Looking at their forward-looking roadmap, it's built out on 5 very clear steps. They're going to keep expanding physical stores and pushing e-commerce, obviously, but I really want to highlight step 4, unleashing growth in the sports and athleisure segment. This is a booming global category, and Metro Brands is aggressively pivoting here through some massive strategic tie-ups with global heavyweights, specifically Foot Locker and Fila. They are perfectly positioning themselves to capture that widespread shift toward casual, athletic lifestyles sweeping across India.
Finally, Section 5, Technical Analysis and Charts. Let's pivot slightly and see exactly how the stock market is pricing in all of this fundamental growth and strategic expansion we just talked about.
Placing the weekly chart right next to the broader monthly view, we can objectively observe the stock's recent behavior. Basically, following a really impressive long-term uptrend, the stock has recently entered a consolidation phase. It's essentially taking a breather. We can see the relative strength index, the RSI, is currently sitting right around that neutral 47 level. So it's neither wildly overbought nor terribly oversold at the moment. It's just waiting for a catalyst.
And as we zoom in on both of those timeframes, a highly critical technical level emerges right here. This alert marker at 98.9. This represents a vital zone of historical support. Market participants, both the bulls and the bears, are clearly monitoring this specific level closely to see if the stock will base out here and resume that upward trajectory, or if it's going to break down further.
So we've explored their 1,000+ store dominance, that brilliant asset-light moat, and those stellar 20% growth rates. But the charts show a stock taking a pause at a critical 980.9 support level. So I'll leave you with this final provocative thought to consider. How will the tension between this pristine, aggressive fundamental growth story and the current technical market consolidation ultimately resolve? Keep a close eye on that support level, and we will see you in the next explainer.